Good afternoon, and thank you for joining us for today's webinar. The topic this time is 5 Steps to Easier Legal Accounting. This webinar is hosted by the ABA Legal Technology Resource Center, and speaking today will be Joshua Lennon from Clio. The Legal Technology Resource Center is an ABA member benefit provided by the ABA Law Practice Division. The LTRC has been providing lawyers with legal technology guidance for more than 25 years. You can find a variety of legal technology articles, guides, videos, and other resources on our website at lawtechnology.org or our blog, lawtechnologytoday.org. Joshua Lennon is an attorney admitted to the New York Bar. He studied law at St. Louis University School of Law, obtaining a Juris Doctorate and a certificate in international and comparative law. During this time, Joshua clerked for the Missouri Attorney General, helping prosecute discrimination claims on behalf of Missouri citizens. Joshua also studied European Union law at the University of Georgia School of Law's Brussels Legal Seminar. Joshua has since helped legal practitioners improve their services, working for Thomson Reuters publishing departments in both the United States and Canada. Joshua currently serves as lawyer in residence for Clio, providing legal scholarship and research skills to the leading cloud-based practice management platform. Thank you all for joining us, and we'll now begin the webinar.
Hi, thank you for joining us. I'm Joshua Lennon. As Rose said, I am the lawyer in residence at Clio. I want to thank Rose and the Legal Technology Resource Center for having us today to talk about 5 steps to easier legal accounting. And we say easier because I don't think accounting will ever be 100% easy, but I think if you follow these 5 steps, you'll get into good habits and have good tools from which to discover the financial background of your firm and how to approve it. I hate presentations that hold the 5 steps until the end, so I thought I would just start off with what the 5 steps are, and that's our agenda. So step 1 is we're going to create a chart of accounts. Step 2 is we're going to pick an accounting tool. Step 3 is we're going to determine the profitability of our firm by taking a look at income statements and balance sheets. Step 4 is implementing the best practices for trust accounting, which is something unique to law firm accounting. So that's definitely why we'll include it. And step 5 is that we're going to set timely reviews based on the type of information that needs to be reviewed over distinct periods of time. And we'll go through each of these in detail, but don't worry, at the end of this, you'll have an idea of how to set up legal accounting for your firm and how to manage it in order to get the best amount of information and financial acumen out of it. So the first step to this is setting up a chart of accounts. And a chart of accounts is simply a detailed listing of all of the names of accounts that is useful for reporting in accounting. This tends to be, if you take any type of accounting course, one of the last steps that they talk about recommending. But I think it should be the first because it gives you an idea of your assets, your liabilities, and your equity within your law firm. And so from there, you need to determine what should be done and how you can then utilize the resources for that. And let's take a look at each of those 3 categories: assets, liabilities, and equity. So the State Bar of Georgia actually has a standard chart of accounts that they've put out, and I use that as an example for us to include here in this webinar. And under assets, amongst other things, they listed cash in bank, petty cash, client advances unbilled, client advances billed, real property. Accounts payable is a liability as well as tax withholding, so your federal income tax, your state income tax, your unemployment insurance, your Medicaid and Social Security taxes, all of which need to be withheld. That is a liability to which you owe. They listed client trust funds as a segregated liability, and I think it's interesting to note that even when listing things in your chart of accounts, client funds are always kept separate. Then they took a look at equity, including owner's equity accounts, where you store the equity from partners that have invested within the firm, and even such things as compensation costs for secretarial, paralegals, and associates. This is just a small segment of all of the different types of accounts that should be included in your chart of account. And if you're interested, you can swing by the State Bar of Georgia's website, and they have an entire listing here. Another good resource for this, while not U.S., is the Law Society of British Columbia. And they include another standard chart of accounts, and theirs is over 3 pages long. What you need to know about a chart of accounts is it is expansive. It includes so much more than you would normally think to consider within your accounting program. And the reason you need to do this is that it gives you a better idea of where all of your assets, liabilities, and equity reside. And that includes things like real property, your office furniture, your rent that is due if you're renting. And so bringing all of these things together is the only way to give yourself a full and complete overview of all of the different financial aspects of your firm. And once you gather these all together, you should then be entering them into appropriate accounting tools. Now, before we get into specific tools, we need to take a look at the types of accounting that are available. There are two types. The first of which is cash basis, which is used by quite a few small to medium-sized law firms, and especially so those use cash basis for their accounting. There's also the accrual basis, and the difference between the two is when revenues are recognized. So in the accrual basis for accounting, whenever you have earned a revenue, so that means as soon as you have committed work for your client and issued a bill, those revenues are deemed earned and should be recognized within your accounting program. But that doesn't mean you've necessarily been paid for them yet. And so in cash accounting, revenues are only recognized when you're paid for the work that you've done. So you may have done work 3 months ago, billed a client, but you don't recognize the revenues in your accounting until you actually receive payment from that client in hand. And accrual does exactly the opposite. They recognize revenue when they are earned, when the bill is issued. And because of that, it has a much different approach to calculation of taxes, because recognizing revenue, say in December when you earned it, versus January when you are paid, can have some large consequences when it comes to filing taxes with the IRS. So what's interesting is most accountants use accrual basis for accounting. It's actually one of the principles of the general accepted accounting principles, and is something that they are almost always required to use. It's also better for tracking the profitability of your firm, whether or not you are earning enough revenues to remain a profitable business. But because most solo and small firms operate on a cash basis, you need to be able to pick a tool that handles both of these. So when reviewing accounting tools, make sure you understand that there is a difference between the two and that you are picking a tool that handles both of them. Importantly, there is a bill in Congress right now called the Tax Reform Act of 2014 that would require the accrual basis for accounting for law firms with an annual gross receipts over $10 million. So the ABA is currently lobbying against this bill. They feel it might impact too many small to medium-sized law firms, but you should be aware that even if you are a small to medium-sized law firm, you may be forced to switch over to accrual-based accounting with all the implications that may have upon your income taxes for both partners and the firm, and you should be able to handle that accordingly. So when looking at the types of tools for accounting, make sure they can handle both, but since most are using cash basis anyway, I'm going to take a look at some examples of the bare minimum you need in an accounting tool. The first of which is you need an accounts receivable tracking. And for the most part, any practice management tool that has bills available will be able to do this. So for example, this is all money owed to a sample law firm. And here you can see within it that the bills are due within a certain amount of time. This one might be past due, and the amount due and who the client and the matters to which they are associated. This is accounts receivable, money owed to the law firm. What you don't see on this page is money to which the law firm owes. So there's no payroll, for example, or withholding taxes. And so all you need for a law firm in cash basis is the idea of tracking bills that are owed to you. You should also make sure that this is client and matter specific billing. So here's an example from Clio where you can take a look at the transactions related to a client. The specific client has put money into a trust fund. Here you can see the payment and the balance at that time. And then again, you can see that the money was transferred out of it to pay a bill with the invoice attached. All law firms should be able to do client and matter-specific billing and be able to break it between the two. So not only should you be able to bill to a case file or a client, but if a client has multiple cases from the law firm, you should be able to see and track money deposited into each one of those case files to the penny. And so that is a basic requirement for law firm legal accounting. Second thing that law firm legal accounting needs to have is the ability to handle multiple accounts. So here again, an example from Clio, and you can see that it gives you the option of picking the account from where you are recording the transaction. All law firms that handle client funds in trust should have both an operating account and a client trust fund account, with most states requiring an IOLTA or IOTA, interest on trust account type accounting, with some very specific reporting requirements for those. And we'll take a look at those in just a little bit. But it's important that you use a system that can handle multiple accounts, especially if you're handling clients' money in trust. It's a great way to get into an ethics dispute if you only have an operating account and are just depositing money within it. So make sure that you have the ability to track multiple accounts and link those accounts to client and fund matters. And since you have multiple accounts, you definitely want to make sure that you can do fund transfers between them and track those together. So within that, within this screen here, you'll see that we do have an invoice, and we have the ability to transfer funds from an IOLTA account to a destination operating account while linking it to a client and a matter. Here, this example here. Using the right tools that have this bare minimum requirement of accounts receivable, client matter specific billing through multiple accounts that allows for the tracking of transfer between those accounts will help you get 90% of the way to your legal accounting. And it's very easy to set these up with any appropriate practice management technology. But make sure you're using that as a checklist. Accounts receivable, client matter specific billing, multiple accounts with the ability to track fund transfers between those. However, in running a small business, you are going to need some more accounting than that. And so I recommend not only having the bare minimum, but also having the ability to sync that with a more advanced accounting program. And what does a more advanced accounting program get you? It gets you even more advanced reporting. It gives you the ability to handle things like liabilities, so things which the law firm owes, and that should be payroll, taxes, and equity distributions. So using a proper practice management tool that syncs out is the way to go. One of the tools that we use here at Clio for our own accounting, and we actually do recommend for lawyers, is a tool called Xero, X-E-R-O, with which you can sync your Clio account into it, and so you can handle all of your basic legal accounting, your accounts receivable, in Clio, and then use Xero to manage the rest of your business accounting. And that's important because business accounting gives you three, I think, required tools. The first of which is an income statement, second of which is a balance sheet, and the third of which is a statement of cash flows. And that moves us to the next segment, which is determining the profitability of your firm. So if you are using the cash basis for accounting, you can't necessarily determine the profitability of your firm over the long term. You can definitely track how much money you've received, but you don't necessarily know if the effort and expenditure of time and assets that you've committed into your business is returning a profit on top of that. So you might have money in the bank, but it's not necessarily tracking whether or not you're growing your business and that you are investing your time and energy wisely. In order to determine whether or not you are tracking that information and investing wisely, you need to use a proper accounting tool, a full accounting suite, that helps you generate a couple of different reports. The first of which is the income statement, which tracks profitability over a specified time. So you might view this as kind of a monthly or quarterly report. And it's often called the profit or loss statement because that's exactly the output. It either shows a positive number, your profit, or a negative number, a loss. And it does this by tracking revenues, expenses, gains, and losses. What it does not track, and this is why it's different than the cash basis for accounting, is it doesn't track cash receipts or cash disbursements. It's not money coming in, but money that is owed to you and money that you owe. And that's what we're taking a look at in an income statement. And it uses a very simple formula for this. The bottom line, whether you're in a profit or you're having a loss, is calculated by adding the sum of your revenues minus the sum of your expenses and losses. And if you can pull all that information quickly and easily from an accounting program, and remember, it'll be pulling from a wide variety of information from that chart of accounts, only then can you determine whether or not you are a profitable company. If you're running this on a monthly and quarterly basis, it will also help you determine your quarterly self-employment tax filings. So it's a great thing to have in order to better estimate how much taxes you should be paying each quarter if you're a solo attorney or if you are a partner in a small firm that tracks income separately. You should be paying quarterly self-employment income taxes to the IRS, and this is the report that will help you get a better handle on how much you owe so that you're not giving too much in taxes to the IRS or too little. So definitely keep an income statement as part of your reporting structure. The other report you should be running is that of a balance sheet. And while the income statement is over a period of time, a balance sheet is a snapshot, literally a day in the life of your law firm. It tracks the current state of assets, liabilities, and equities, the exact same thing we talked about in your chart of accounts. And this includes things like work in progress fees, loans, so if you have a credit line with your bank, and also retained earnings and income distribution. It takes a look and gives you in a snapshot what exactly you have on hand in case of rainy day, in case of clients not being able to pay. This is what determines the longevity of your law firm over time. And it too has a very simple accounting formula. Assets is equal to liabilities plus equity. But if you haven't done that chart of accounts that we talked about in step 1, you can't necessarily easily generate this. So make sure you go through step 1, generating that chart of accounts. Pick a tool that gives you this type of reporting functionality, and then you'll be able to see not only whether or not your firm is profitable, but whether or not you're able to weather good times and bad. The last thing you should be getting from a proper accounting tool is a statement of cash flows. Now this is where cash accounting comes back into accrual-based accounting. And what it does is it shows you cash amount change over time. So while I might be billing lots of hours, if my clients aren't paying me, I may be profitable on paper, but penny poor at the bank. A statement of cash flows, when combined with the other two reports, will show not only whether or not I am profitable, but whether or not I'm handling my collections and having a good realization rate for my billing. This is also one place where lawyers' trust accounts will be tracked, so it's important that you're running this as well if you're using the accrual-based accounting system in order to make sure that you're keeping tabs on your trust account. All of this creates what's called a double entry bookkeeping, where anytime an entry to an account is made, it requires a corresponding or opposite entry to a different account. This is actually really difficult for most people who aren't accountants to get a handle on. And that's why I recommend picking a good tool like Xero that does a lot of the double entry work for you. And what it does is every time it creates a debit, money that is owed to you, it also creates a credit in another account and gives it the ability to check against these two different columns to make sure that they're always adding up. Remember, assets is equal to liabilities plus equity on the balance sheet, and double entry accounting is always making sure that those two sides balance out. And when they balance out, you're probably doing the best practices for your trust accounting. So trust accounting is a very specific type of requirement to lawyers. Let's take a look at some of the bare minimum that you should be handling. This is pulled from Florida's Rule 5-1.2, Trust Accounting Records and Procedures. If you're handling any client's money in trust, so that includes any type of advance fee payment. Some people call this a retainer. I want to make clear that a retainer is money paid simply to retain your services. It is not money for advanced work. So a retainer should go into your operating account because it's just cash on hand. But if you're being paid for advanced work, work to which you will bill against, That is an advance fee, and it goes in a trust account. And Florida requires deposit slips, a cash receipt book, disbursement records, a ledger for both client and matters, and bank statements to be kept for all of that. That's the bare minimum of record keeping that you should be able to do with that. If you're pulling an accounting tool that does allow for client and matter specific billing with multiple accounts, it's actually very easy to generate this. Here's an example of an IOLTA trust account report generated by a client in Clio. This is, again, all separate, all examples, so not an actual case. But it does show the funds in, the funds out. Remember that kind of double entry bookkeeping that we talked about? And then the balance as you get to the end of this. And what you're going to see is this all adds up together to become this final entry, something that's done automatically for you by picking the right tool. Florida also requires specific accounting to be done, mostly on a monthly basis. They require a monthly reconciliation where you check the balance in the bank versus your own records. They require a comparison of the reconciled balances and ledgers, so that report that we just saw an example of earlier. They require an annual listing that also reports on unexpended trust account, and they require the lawyer or the managing partner of a firm to put forth an accounting certificate, an affidavit of following of the best practices for trust accounting, and they require you to keep these records, including the record from the previous page, for 6 years. So you should be picking a tool that allows you to quickly and easily do all of these things, including record retention. And that record retention, I want to just touch on really quickly. Under Florida, they either require you to keep the original or clearly legible copies. And what's great in this modern day and age is that it's very easy for us to run electronic reports for all of our different accounting systems. A tip that I recommend is that when you run these reports, print them as a PDF, and then use your own accounting or document management system to save these reports as a PDF in the case file for the client or the client's matter. So that way it's very easy to search for them and produce them when necessary. So a PDF would fall under this clearly legible copy. Scan all of your bank balances into there, scan all of your canceled checks, and make sure that you're keeping track of all of this information in a way that's easily searchable, because you are required to be able to produce this information when demanded by either the client or your regulatory authority, like your state bar or your discipline committees, and not being able to find them because they're in the bottom of a banker box in a closet or a storage unit is not a defense. So take advantage of the rules as written to make sure that you have a way to find clearly legible copies that are accessible from any system. And that moves us to our last step, setting timely reviews. So I think really quickly we can take a look at the different types of reviews that need to be done and when they should be done. Daily reviews are definitely a requirement. Individual lawyers should be reviewing their daily time entries to make sure that they're capturing all of their time. You can be using time trackers like the time tracker built into Clio, or other ones like Timekeeper Daily, to make sure that you're definitely pulling all of your document time together. There should be a weekly review of either the practice team leads or the administrator to make sure not only are lawyers entering their time on a daily basis, but they're also meeting firm guidelines for how that time should be entered. So if the client has specific demands, like leads-based billing, making sure that your lawyers are meeting that, or if there is a style guide for how bills should be, how time entry should be listed, this is where that should be checked out. You shouldn't wait until the end of the month to see that all of your time entries are now using horrible spelling and abbreviations and won't make sense to your clients when they view their bill. If you do it on a weekly basis, it's much easier to catch these errors and make sure that they're all taken care of prior to the end of the month. At the end of the month, your administrators and managing lawyers should review not only the bills that go out, but also your trust account information and complete your reconciliations. So review your bank statements against your trust record accounts. And this also might be a great time to run the income statement and balance sheets that we talked about before, to get that snapshot of your firm's assets and the idea of whether or not it's been a profitable month for you, or if you need to review the type of expenditures that you're doing to maybe guide your firm back towards profitability. If you're not doing it on a monthly basis, you should definitely be running those reports on a quarterly basis. One, it helps with your self-employment tax filings, but two, it's the best time to check your firm's profitability and make sure you're on the right track. And then lastly, there should be an annual review, definitely to both meet your state's requirements for trust fund certification, but also to prepare for your annual tax filings. And a good accounting program will help with the disbursements of capital at this point in time up to your partners and help you prepare for your income tax reviews. So the takeaways are the 5 steps that we just talked about. Take the time to create a chart of accounts. Make it expansive. Pick an accounting tool that can handle all of these different types of accounts. And then use that accounting tool to run timely reports on your income statement and balance sheets. So that means you need to pick a tool that not only handles cash-based accounting, like we talked about before with accounts receivable, to multiple accounts with the ability to transfer funds, but also something that can also run these 2 specific reports, income statements and balance sheets. Make sure you're implementing the best practices for trust accounting on the rules for your own jurisdiction. We took a look at Florida. Lots of them are very similar in rules, but definitely make sure that you're following the exact rules for your period, for your jurisdiction, including taking advantage of the electronic records storage. And then lastly, set timely review. And while it may seem like a lot, it's just 5 to 10 minutes with the right tools to make sure that you're on the right track for your firm's finances. So thanks so much for attending.